Good day, everyone. My name is Adam Livingston. I am the Bitcoin wizard broadcasting for Swan Bitcoin. In the span of a single trading day here on October 10th, 2025, $19 billion worth of turbocharged hopium got vacuumed out of the crypto markets, taking 1.6 million over-leveraged dreamers with it. The charts looked like Niagara Falls in fast forward. The longs were detonated, the shorts cheered, and Telegram groups turned into digital group therapy. This was the largest single-day wipeout in crypto history yet. While the altcoins were quietly playing gravity bingo, Bitcoin simply bent its knees, absorbed the shock, and kept more than half of the entire market's value under its orange umbrella. Today, I'm going to dissect the play-by-play of the now infamous October 10th, 2025. I'm going to unpack why that tariff headline was the match in a fireworks factory and show how Bitcoin once again proved it is built for a Category 5 leverage hurricane. I hardly had time to finish the news headline before the future screen lit up like a Christmas tree. One tariff tweet, that is correct, President Trump had a surprise announcement of a 100% tariff on Chinese software imports, and the entire risk complex hit the eject button at once. But remember, there was only one market open on Friday afternoon, and it was crypto. You could almost hear the collective gasp of all the Zoomer traders who just levered their rent money to the moon, only to watch the liquidity evaporate faster than free beer at a frat party. Some of the traditional markets stumbled a little bit in after hours, sure, but crypto was already tiptoeing along a tightrope of 25 times leverage, so the slightest geopolitical tremor felt like the San Andreas. What started as a very routine risk-off shuffle then morphed into an all-out stampede for the exits, the margin clerk slicing positions with the precision of a sushi chef. As the tariffs then ricocheted through the macro desks, cascading liquidations turned orderly order books into a blender set to puree. And then suddenly every single altcoin chart in the world took on an aerodynamic shape of a throwing knife. This is the spark that lit the powder keg. Yes, a Trump tweet. And it is why the next few minutes will feel like watching slow motion footage of a controlled demolition, except nobody was in control. Here's what the raw data tells us. $19 billion of margin vanished in 24 hours, the largest notional liquidation ever captured by derivative feeds. That capital was spread out across roughly 1.6 million trader accounts, but the distribution was anything but even. $7 billion flushed in an approximate single 60-minute window, which means liquidation engines were firing at an average of almost $2 million per second. Hyperliquid alone posted $1.23 billion in deficits across 6,300 wallets, and 205 of those wallets lost north of $1 million. That concentration underscores how tail risk scales on venues that let leverage float well beyond industry medians. The single biggest kill order was an $87.5 million BTC/USDCT liquidation. That was on HTX, one trade, one venue, instant vaporization, which is now a case study in venue-specific liquidity risk. Zooming out, the long to short wipe ratio came in about 7-1. In other words, the bulls were almost the entire counterparty to forced unwinds. That asymmetry signals two things. Market structure still leans heavily pro-risk during uptrends, and when macro shock hits, the deleveraging vector runs almost exclusively through long books. For Bitcoin, this is validation of its relative position on the risk curve. BTC endured the same systemic shock, but absorbed only low teens percentage drawdowns, while dominance ticked higher. That quantitative contrast between altcoins and Bitcoin, the depth-adjusted drawdown versus the liquidation density, is what separates a liquidity anchor from a beta proxy. The numbers on this slide are just the forensic evidence. Quantifying the damage, Bitcoin's peak to trough was 125K early Friday, down to a low of 102, but settled around $113,000. A drawdown that fits very comfortably within its historical daily value at risk. Ethereum went twice as deep as Bitcoin at negative 20% intraday, confirming that its perp markets run with more than double Bitcoin's aggregate leverage. And once we move down the market cap stack, the elasticity of the order book totally collapses. XRP printed a minus 42% intraday wick, and a wide sample of DeFi tokens recorded 30 to 60% air pockets on sub-second timeframes. The dispersion between the cryptos here is a textbook illustration of liquidity tiers. Depth within 2% of mid-price on BTC pairs averaged 8 times that of Ethereum during the entire cascade, with more than 20 times that of mid-cap altcoins. When the liquidation engines start to fire, Bitcoin's thicker books absorbed the inventory, while the thinner books amplified the price impact in a positive feedback loop. In practical terms, my dear listeners, 1 unit of forced selling in BTC translated into 1/10 the price slippage experienced by an equivalent notional in XRP or Solana, which explains why Bitcoin's market dominance expanded. Capital rotated to the instrument with the lowest impact cost and the most robust collateral profile. These relative drawdowns are not just the headline numbers, kids. They are a quantitative signal that the market treats Bitcoin as the primary risk-off asset inside the entire crypto complex. Bitcoin's share of the entire crypto pie just punched through 58%, sitting at 58.4 right now, a 2-point jump in 48 hours. Now, that may sound incremental, but in market cap terms, it means roughly $130 billion rotated out of those high beta assets and into Bitcoin. Dominance is the crypto equivalent of the dollar index. When it rises in a crash, it signals a flight to collateral quality. The two mechanics that drove this flow were the liquidity engine settling margin in the base currency of each pair. So forced unwinds on the alts mechanically converted exposure back to Bitcoin or stablecoins. Second, discretionary traders hedge systemic stress by parking risk in the asset with the lowest impact cost and the deepest derivatives coverage, and empirically, that has always been Bitcoin. Historically, every dominance uptick north of 1 percentage point during a cascade has coincided with a net reduction in the aggregate leverage. This episode was no exception. Open interest fell 24%, the dominance of Bitcoin climbed, and realized correlation between Bitcoin and the rest of the entire crypto basket dropped, confirming capital consolidation in the most liquid rail. Bitcoin is the best. There is no second best. Now, interpreting this structurally, Bitcoin is no longer the oldest chain, folks. It is the clearing layer for crypto's risk curve. When volatility shocks the system, everything reprices relative to Bitcoin's balance sheet strength. That dynamic did not disappear with the new ETFs or scaled altcoin ecosystems. It has just intensified. Yesterday's dominance spike is quantitative proof that BTC is the liquidity anchor, the fail-safe collateral, and the asset that institutions reach for when the derivative tower wobbles. First, note the stablecoin wobble. The yield-bearing USDE briefly slipped to 65 cents before it repegged. It lost 35 cents of parity before it clawed back to $1. That temporary depeg tells us that collateral quality matters once funding turns sharply negative. In very stressed markets like the crypto market on Friday, well, algorithmic or leveraged stablecoins face forced redemptions, and the peg then becomes a referendum on how credible the underlying collateral really is. Second, look at the derivatives premium collapse that occurred. The perp funding flipped from plus 20% to minus 40 within just a few hours. Positive funding means that the longs are paying the shorts, while negative funding turns the table. Such a violent swing forces automatic position reductions, since traders who were paying a small carry suddenly face a punitive rate. The rate inversion effectively taxes the over-leveraged longs right when their P&L is already underwater, which then accelerates the unwind. Third, the open interest reset quantifies the purge. Aggregate futures fell 24%, sliding from 52 billion to 39 billion in half of a day. That 18 billion reduction equals the combined open interest on the 4 largest offshore venues 2 months ago. So the deleveraging was both very deep and very quick. The market It now carries materially less gross exposure, which lowers reflexivity, but it also means any fresh leverage will now be rebuilding from a much cleaner baseline. These stress signals literally just confirm that liquidity shocks just propagate through three channels: collateral confidence, funding mechanics, and position sizing. Bitcoin's dominance rose because it scored best on all three metrics, while instruments with weaker collateral, higher carry volatility, or thinner depth bore the brunt of the liquidation cycle. Bitcoin holds up better because it has lower effective leverage, deeper spot liquidity, and a macro narrative strength that cannot be bested. Bitcoin has established itself as the inflation hedge and the geopolitical hedge inside the entire digital asset universe. When risk blows out, discretionary desks rotate the capital back into Bitcoin, both to reduce their beta, but also to maintain crypto exposure that will satisfy any headline risk committee or anybody with common sense. And that reflexive flow helps reinforce the liquidity advantages and helps Bitcoin recover sooner once all of that volatility normalized. When you put all of these three together, you get a stress-tested asset that endures 10% drawdowns like it's nothing, while its peers printed 30 to 60% drawdowns. That structural resilience of Bitcoin is why its dominance just rises during every major liquidation cycle, including the one that we just analyzed. Here is where the data points us next. Yesterday's implied volatility shock pushed 1 week BTC options to roughly 130%, but that premium has already begun to compress while the risk reversal skew tilts bullish. Options desks read that shift as fresh conviction from dip buyers rather than blind leverage, so short-dated vol should decay while longer tenors stay bid until macro uncertainty clears. The market dominance over 60% signals that allocators now prefer Bitcoin exposure over high beta tokens for the time being. I imagine that this will scare some folks. Unless the tariff narrative fades immediately or a new liquidity catalyst appears, flows are likely to favor Bitcoin over the coming weeks, I would imagine, reinforcing the collateral aura that Bitcoin has and delaying any sustained altcoin rebound. You can bet that the risk desks are now reviewing leverage ceilings after a $19 billion drawdown. Exchange operators are now going to face the same regulatory and reputational pressure that followed May 2021. I would expect tighter initial margin, lower leverage multiples on totally illiquid pairs, and possibly dynamic funding caps that expand only when the depth does improve. From an institutional lens, Bitcoin still prints an 80% year-over-year gain after yesterday's drop, at least from a historical perspective. Go ahead, look up the Bitcoin Kager, I'm not lying. The boards, the treasury committees, literally any institution in the world can see what just happened and witness the comparative carnage in the altcoins, which underscores why the retail-driven leverage cycles remain the primary systemic weakness outside of Bitcoin. The bottom line is that deleveraging wiped the excess froth, but it also re-established Bitcoin as the liquidity and the narrative anchor of the asset class. If history rhymes, the clearer positioning, the elevated dominance of Bitcoin, and the moderating volatility, it just paves the way for Bitcoin to lead any next leg recovery while the altcoins rebuild confidence at a much slower pace. There is no second best. This is just proof that the orange singularity is unstoppable. My name is Adam Livingston. I am the Bitcoin Wizard. If you like this video, please subscribe to Swan Bitcoin. We bring daily Bitcoin insights that are incredible, so just do it. Like the video too. Thanks so much. Have a terrific day. Don't party too hard. Class dismissed.